Welcome to the strategy briefing of the Wealth Architecture series, where we explore the mechanics of long-term financial success. Today, we are looking at the compound growth engine and architecting your retirement tax strategy. For most people, the conversation around retirement planning starts and ends with a simple choice between traditional or Roth accounts. However, we are going to go much deeper than that surface-level debate. We are launching a data-driven analysis of lifetime wealth optimization to understand how different tax structures impact the velocity of your wealth accumulation. This is not just about saving for the future, but about engineering a system that maximizes every dollar you earn across your entire lifespan. We will look at the mathematical underpinnings of growth and how different tax environments can either act as a catalyst or a drag on your portfolio. By the end of this presentation, you will have an architectural blueprint for your own retirement strategy that moves beyond guesswork and into the realm of precise financial engineering. Let us dive into the math and the mechanisms that drive the world of tax-optimized growth. To understand the complexity of tax strategy, we must first establish a baseline using the equivalence principle. This principle illustrates the math of all else being equal. Imagine you have $1.28 in pre-tax income. In a traditional 401k scenario, you invest that full amount today. If it grows at 8% and is taxed at 22%, when you withdraw it at the exit point, you are left with $1.08. Now consider the Roth 401k path. You start with the same $1.28, but you are taxed at 22% right, now leaving you with exactly $1 to invest. If that $1 grows at the same 8% rate and is withdrawn tax-free at the exit, you again end up with $1.08. This simple calculation yields a profound insight, which is that if tax rates remain constant over time, the outcome is mathematically identical regardless of whether you pay taxes now or later. The choice between traditional and Roth only matters when we introduce variables that cause tax rates to diverge between the contribution phase and the distribution phase. Understanding this baseline is essential because it shows that the real value of tax planning lies in managing the delta between current and future tax rates. While the equivalence principle provides a stable starting point, the real world is rarely that simple. In practice, three major forces of divergence act upon your wealth, and most models completely miss the interaction between them. These forces are the tax bracket trajectory, the time multiplier, and forced distributions. The tax bracket trajectory refers to the curve of your income and effective tax rates over your career. The time multiplier represents the power of compound magnification over decades. Finally, forced distributions, or required minimum distributions, represent the cliff that many retirees face when the government dictates their income levels. What is critical to understand is that these forces do not just add to each other, they actually multiply. When you have a high tax bracket, a long time horizon, and forced distributions, the interaction creates what we call the wealth gap. This gap can represent hundreds of thousands or even millions of dollars in lost potential. By mapping how these circles overlap, we can identify the specific points where your strategy needs to be adjusted to prevent wealth leakage. Our goal is to minimize the area of the wealth gap and maximize the net capital available to you throughout your lifetime. Let us take a closer look at the tax bracket trajectory, which serves as the map for our optimization strategy. Most people experience a predictable rise in their effective tax rate as they move from their mid-20s into their peak earnings years. Between ages 45 and 55, many high earners enter the traditional arbitrage zone, where their income is at its highest, and they are paying the highest percentage in taxes. However, unique opportunity often appears after retirement, but before age 73, which we call the valley. This is the Roth conversion window where your income drops significantly and your effective tax rate hits a low point. Optimization depends entirely on your ability to bridge the gap between your peak rate and your valley rate. If you do not plan correctly, you will eventually hit the RMD spike, where forced taxation pushes you back into a higher bracket. By visualizing this life cycle of taxation, we can see exactly when it makes sense to defer taxes and when it makes sense to accelerate them. The objective is to pull income from the peaks and push it into the valleys to create a lower lifetime average tax rate which keeps more money in your pocket. The second force of divergence is the time multiplier, and it is the primary reason why even small tax advantages lead to massive outcomes. Consider a scenario over 35 years with an 8% return comparing 22% current tax versus 12% future tax. Over a short period, the difference might seem negligible, but time magnifies that 10% tax spread into a significant wealth gap. In this specific model, a traditional portfolio might reach $1.63 million, while a Roth portfolio might sit at $1.45 million. This creates what we call the tax drag delta, which in this case is $187,000. It is important to remember that time does not change the winner, it simply clarifies the margin of victory. The longer your investment horizon, the more critical it becomes to ensure you are on the right side of the tax equation. Even a slight miscalculation in your early years can lead to a massive discrepancy in your final portfolio value. This is why we treat tax strategy as a core component of the growth engine rather than an afterthought. Compounding works for your wealth, but tax drag compounds against it. Now we must address the RMD cliff, which is often referred to as the penalty of success. During your working years, you might have a steady income of $150,000. In early retirement, your income might drop to $60,000 as you live off fixed income or Social Security. However, at age 73, the government mandates that you must withdraw approximately 3.8% of your pre-tax balances every year. For a successful investor, this required minimum distribution can easily reach $70,000 or more on top of your existing fixed income. This move artificially inflates your taxable income and can trigger bracket creep and Medicare surcharges. You are essentially being forced to take money you might not need at a tax rate you did not plan for. This creates a massive conflict for those who have spent their entire lives successfully growing their traditional accounts. The RMD cliff is the ultimate reason why tax diversification is necessary. If all your wealth is tied up in pre-tax accounts, you lose control over your income levels in your later years. By planning for this cliff, now we can implement strategies that allow for more flexibility when you reach your 70s and 80s. Moving into advanced strategy, we shift our focus to engineering the spread. This is where we move beyond basic savings and into tactical arbitrage sequence protection and mega funding. The goal is to move from a passive participant in the tax system to an active architect of your own financial outcomes. Engineering the spread involves looking at every available mechanism to maximize the difference between the taxes you pay and the wealth you keep. We are looking for opportunities to exploit the tax code in ways that are perfectly legal but highly efficient. This includes understanding state-level nuances, protecting against market volatility, and utilizing specialized account structures that the average investor might overlook. The following sections will break down 5 specific strategies that high earners use to gain a competitive edge. These strategies are designed to work together to create a robust and flexible wealth plan. If you want to achieve elite financial results, you cannot rely on average advice. You must understand the underlying engineering that makes high-level tax optimization possible and apply those principles to your specific financial situation. Strategy number 1 is the fundamental concept of tax arbitrage. In the world of investing, we often hear the phrase buy low and sell high. Tax arbitrage applies this same logic to your income. The goal is to defer income when it costs you 32 cents on every dollar in taxes, and then realize that income when it only costs you 12 cents. This creates an arbitrage spread of 20% in pure savings. For high earners, this strategy generates a guaranteed alpha that pure investment returns often struggle to match. Think about it, this way to get a 20% net gain from a stock market investment, you have to take on significant risk and wait for the market to move in your favor. With tax arbitrage, you are locking in that gain simply by choosing when to pay the tax. This is particularly effective during your peak earning years when you are in the highest marginal brackets. By shifting that income to a later period, when you have more control over your taxable distributions, you are essentially capturing a massive risk-free return. This is the cornerstone of any sophisticated retirement plan and serves as the primary driver for using traditional pre-tax accounts during your most productive years. Strategy number 2 is geographic arbitrage, which adds another layer of complexity to the tax equation. We often focus on federal taxes, but state taxes can vary wildly and have a massive impact on your net wealth. We can categorize moves into 3 groups. Group 1 is moving from a high-tax state like California to a zero-tax state like Nevada. This creates a state bonus of 9.3% on top of your federal savings, which represents a double arbitrage opportunity. Group 2 is the opposite, where moving from a zero-tax state like Florida to a high-tax state like Oregon creates a state penalty of 9%, which can actually wipe out your federal tax savings. Group 3 is neutral moves, where you stay within the same state system. A move from a high-tax city like San Francisco to a low-tax state like Nevada is a classic example of maximizing your wealth through relocation. You should always factor potential migration into your break-even analysis when deciding between Roth and traditional accounts. If you plan to retire in a state with no income, the argument for traditional pre-tax contributions becomes significantly stronger today. Geographic planning is a powerful lever that can save you 6 figures over the course of your retirement. Strategy number 3 involves sequence of returns protection and utilizing the Roth account as a safety valve. Market volatility is an unavoidable reality of investing. The problem is that withdrawing from traditional pre-tax accounts during a market crash locks in your losses and triggers a tax bill at the same time. This is a double blow to your portfolio. However, if you have a Roth account, it acts as a volatility buffer or a safety valve. When markets are down and your traditional assets have lost value, you can choose to withdraw from your Roth bucket instead. Since these withdrawals are tax-free, you avoid the tax hit, and more importantly, you give your traditional assets time to recover without being forced to sell them at a bottom. We see this in the graph comparing Investor A and Investor B. The investor with the Roth safety valve can navigate the troughs of the market much more effectively than the investor who is forced to liquidate depressed assets. This tactical flexibility is one of the most underrated benefits of having a diversified tax portfolio. It is not just about the tax rate, it is about having the right tools to manage risk during the distribution phase of your life. Strategy number 4 is the mega backdoor Roth, which we often call the cheat code for high earners. Most people are limited by the standard 401k contribution limit of $23,000. However, many employer plans allow for after-tax contributions that can bring your total annual funding up to $69,000. By using an immediate conversion event, you can move these additional funds into a Roth bucket where they can grow tax-free forever. This allows you to shelter an additional $30,000 or more every single year in tax-free space. For someone in a high-tax bracket, the benefit of long-term tax-free growth far outweighs the immediate tax costs of the conversion. This strategy effectively triples the amount of money you can get into a Roth environment compared to standard contributions. It is a powerful tool for those who have already maxed out their other retirement options and are looking for more ways to optimize their wealth. While not every employer plan supports this feature for those who have access to it, the mega backdoor Roth is one of the most effective ways to build a massive tax-free nest egg in a relatively short period of time. Strategy number 5 is tax diversification, and the core message here is to not bet on one single future. A diversified allocation across different tax treatments provides the flexibility to control your effective tax rate in retirement. As we look across the decades of a career, your optimal mix will likely change. In your 30s, you might have a high concentration in Roth assets. As you enter your peak earnings in your 40s and 50s, you might pivot more towards traditional assets to capture the current tax deduction. Then in your 60s, you might focus on Roth conversions during the income valley we discussed earlier. By maintaining buckets in both traditional and Roth accounts, you give yourself the ability to choose where your income comes from in any given year. This allows you to stay within lower tax brackets and avoid the spikes caused by RMDs or unexpected capital gains. Think of tax diversification as an insurance policy against future changes in tax law. We do not know what tax rates will look like 20 or 30 years from now, but by having a mix of assets, you are prepared for whatever legislative environment emerges. It is the only way to ensure you have maximum control over your financial destiny. To help you make these decisions, we have developed a 7-point inspection as part of our decision matrix. First, you must look at your current marginal rate. If it is high, favor traditional; if it is low, favor Roth. Second, project your future effective rate by estimating your RMDs and Social Security income. Third, consider your time horizon, because a longer horizon favors the compounding power of Roth accounts. Fourth, factor in your geographic plans, especially if you're moving between high and low tax states. Fifth, assess your flexibility needs and whether you want to avoid the restrictions of RMDs. Sixth, look at your expected returns. High alpha or high growth investments favor the Roth side to avoid what we call the success tax on massive gains. Finally, consider your other income sources, such as pensions, which might already fill up your lower tax brackets and make Roth more attractive. By running through this matrix, you can see which direction the data is pointing for your specific situation. This inspection turns a complex emotional decision into a logical and systematic process. It ensures that every aspect of your financial life is working in harmony to produce the best possible after-tax outcome. Finally, we look at the Monte Carlo reality of hedging uncertainty. When we run thousands of simulations, we see that a mixed strategy often results in the lowest variance for your portfolio value and tax liability. There are several key risks we are hedging against. Legislative risk is the danger of future tax hikes, and Roth accounts protect you from that possibility. Longevity risk is the danger of outliving your money, and Roth accounts help by protecting against massive RMDs when you are 90 or older. Then there is the success tax, which is the high tax bill that comes from extreme portfolio growth. The data shows that unless you have a crystal ball to predict the future, diversification is the only free lunch in financial planning. By spreading your assets across different tax buckets, you are creating a more resilient wealth structure that can withstand different economic and political environments. The goal is not just to have the highest possible number on a spreadsheet, but to have the highest amount of usable wealth regardless of what the world throws at you. A balanced approach provides the stability and peace of mind that comes from knowing you have engineered a strategy for any scenario. In conclusion, the final calculation for your strategy is the advantage multiplied by the balance, where the advantage is the difference between your tax rate now and your tax rate in the future. The math is the blueprint, and your job is to engineer the spread. Start by calculating your current true marginal rate, including both federal and state taxes. Then estimate your retirement effective rate by considering your base income and expected RMDs. Finally, find your arbitrage spread and use that to guide your contributions. Remember that tax planning is not a one-time event, but an ongoing process of optimization. By using the principles we have discussed today, you can build a compound growth engine that works for you for the rest of your life. Please share your feedback in the comments. We love hearing your ideas for future videos as well. If you find this useful, please share, like, and subscribe. And smash that notification bell to stay updated on our latest content. Thanks for watching, and see you in the next video.